Hello and welcome to this Edison results webinar with me, Andy Murphy, and the management team of the early morning supply chain leader, Smiths News. It gives me great pleasure to introduce John Bunting and Paul Baker, who are the Chief Executive and Finance Director, and who have driven the core business, the very notable decline in debt, and the emergence of the exciting diversification story. In a moment, I will ask John and Paul to present the Smiths News interim results, and then I will come back and ask some key questions to help investors better understand the Smiths News story. So, with the introductions done, I will hand over to the team to run through the interim results. Gentlemen.
Thank you, Andy, and good morning, everyone, and welcome to Smiths News interim results for the 26 weeks ending the 1st of March 2025. I'm John Bunting, CEO of Smiths News, and with me today to talk through our half-year results presentation is Paul Baker, our Group CFO. Starting with the headlines, we've made a good start to the current financial year, and the business is on track to deliver FY 2025 results in line with market expectations. We've seen an increase in operating profit, up 3.2%, alongside a strong cash flow performance in the period. As highlighted in our full-year results in November last year, we continue to leverage our news and magazine business whilst also seeking to drive growth. We've made progress across all three growth verticals, comprising Smiths News Recycle, New Categories, and Final Mile. Our internal investment programme has also gathered pace, with the successful implementation of a new warehouse management system at one of our regional hubs, and the broader rollout will be complete in this financial year. We have 91% of existing publisher revenue streams secured to 2029, which not only provide assurance of revenues across the short and medium term, but also provides the foundations to support our strategic intent to broaden our early morning end-to-end supply chain solutions. We have again generated strong cash flow in the period, and today announced a proposed interim dividend of 1.75 per share. I'll now hand over to Paul to walk through the financials before coming back to discuss each of these points in more detail later in the presentation.
Many thanks, John, and good morning, everyone. Starting with the financial summary, revenues declined by 0.6% in the period, lower than our guidance of a 3 to 5% decline, supported by the benefit of the 2024 contract wins in London and the Midlands, as well as football and Pokemon collectibles. We will look at revenue in more detail on the next slide. Adjusted operating profit increased by 0.6 million to 19.4 million in the first half, driven by improved sales in collectibles, the annualisation of our 2024 contract wins, and increased profit from our growth activities. Importantly, our ongoing cost efficiency programme is in line with plan, and in the first half delivered another 3 million of gross improvements. Adjusted earnings per share increased by 10% to 5.4 pence, benefiting from the increased operating profit and the lower interest costs under our new banking facility signed in May last year. Average net debt reduced by 11.4 million to 1.1 million, driven by consistent cash flow in the first half, but noting that the ordinary and special dividends were paid in February at the end of the reported period. Just to give a little more colour to our revenue numbers, our headline revenue number shows a 0.6% decline in the first half, which is again below the 3 to 5% annual decline which we guide to. Since COVID, our underlying newspaper and magazine performance, which makes up over 90% of our total revenue, has been impacted by a number of things: pricing, contract wins, and last year, the 53rd trading week. So, for example, the annualisation of the additional contract wins last financial year give a 1.6% benefit year on year, and this drives the majority of the difference between our headline number of a minus 0.6% and the guidance. If you exclude this annualisation, newspaper and magazines showed a decline of minus 3.1%, which is within our expected range, albeit at the lower end. Collectibles increased in the half by 4.3%, demonstrating the continued popularity of football collections and the increased interest in the latest Pokemon series. Revenue from our strategic growth initiatives, while relatively small, compared to the headline newspaper and magazine revenue also contributed to the headline movement, increasing by 25% in the period. Onto the adjusted income statement. Below operating profit, net finance charges in the period are 1.2 million lower than last year, driven by the continued reduction in average debt and the improved commercials in our banking facility signed last year. We recently extended this facility for an additional year to May 2028, and we have a remaining option available in 12 months' time to extend further to May 2029. With lower finance charges, profit before tax increased by 1.8 million or 11.3% to 17.7 million, with earnings per share then increasing by 10% to 5.4 pence. An interim dividend of 1.75 pence, in line with last year, has been approved by the board and will be paid in July. Total free cash flow for the half was an inflow of 13.3 million, an increase of 9.1 million from last year, partly due to the favourable timing of our working capital cycle, but also including inflows from both the McCall's administrators and the pension tax refund, which are included within adjusting items of 2.1 million. Capital expenditure at 2.3 million is 0.4 million higher than last year, and we expect this rate to accelerate into the second half in line with our planned increase in investment over the next 3 years. Lease payments have increased by 0.6 million year on year due to inflationary impacts on lease renewals, of which there have been 7 over the last 12 months. Net interest and fees are lower than in 2024 by 0.8 million, thanks to the cash impact of the lower levels of borrowing and the interest margins mentioned earlier. Over the last 12 months, the business has generated an underlying cash inflow of 24.2 million, consistent with the 20 to 25 million annual inflow the business has been delivering for some time. Additional income, including the amounts received from the McCall's administrator and the pension tax refund, have been positive one-offs, recorded in adjusting items of 2.1 million. Over the last 2 years, we have focused on average net debt as a headline measure, as reported net debt is impacted by the timing of our working capital cycle. Average net debt reduced from 12.5 million in the first half 2024 to just 1 million in 2025, noting that the dividend payments were made at the end of the period in February and do not significantly impact the average. As a reminder, at the end of the last financial year, we announced a special dividend on top of our 2 times ordinary dividend. For the current year, the board will again assess the cash generated from the business, along with the needs to invest in both the core and growth sides of the business before deciding any further distributions in line with our capital allocation policy. I'll now hand back to John.
Thank you, Paul. I'll now do a quick refresh of our strategic priorities before looking at our H1 performance in a little more detail. Before I walk through our operational and strategic progress, I wanted to quickly remind everyone of our broader vision for the business. Simply put, our aim is to consolidate our position as one of the UK's leading providers of early morning end-to-end supply chain solutions, and our substantial news and magazine footprint provides an ideal platform to deliver that. We're doing this by making our customers' lives easier and more profitable, enabling them to focus on what they do best. Our existing news and magazine business is a great example of this purpose in action. Our publisher clients could create their own distribution teams, drivers and van fleet, but this is not what they do best. What they do best is create fabulous content for consumers. Having a trusted partner to undertake the logistics execution enables our clients to fully focus on their areas of differentiation. Lastly, our existing capabilities and expertise will ultimately provide the backbone to our success. We already deliver end-to-end services and are able to draw on our significant experience in warehousing logistics and reverse logistics. We have an established presence in the all-important early morning and final mile markets, and we are able to leverage our high-density UK delivery network to further grow. Turning to the next slide. We have a very well-established and respected logistics business that has 2 distinct features: an early morning focus and a high-density B2B final mile delivery and collection capability. We have established our proven expertise in the time-sensitive newspaper and magazine industry, but these are core competencies that are transferable. Our strategy therefore seeks to do just that, build out from our existing news and magazine business into 3 new and targeted verticals that offer the potential to penetrate circa 160 million of profit opportunity. Our strategy strives to exploit that in a controlled and measured way, complementing our news and magazine business. Within news and magazines, we've delivered another robust performance in the period, showing minimal headline revenue decline at just 0.6%, which, as Paul explained, was ahead of our medium-term expectations of an underlying 3 to 5 percentage points decline. We have 91% of publisher revenues contracted to 2029. Revenues were boosted by collectibles in the period, including strong demand for football collections and the latest Pokemon collection, which has been particularly popular this year. We continue to invest in strengthening our core capabilities while simultaneously maintaining our asset-light business model, which supports and enables our ongoing cost-out programme. We are on track to deliver circa 5 million of cost savings once again this year. I will provide more granularity on our investment in our future capability later in the presentation. Turning to slide 14 to look at our recycling activities in more detail. We are continuing to make progress in expanding our operations and driving up demand from our existing customer base, with customer numbers up 5% versus FY 2024, across over 900 routes. As detailed at the full year results in November, we have evaluated the economics of this market, which is worth 230 million in revenue, is growing at 3 to 5 percentage points per annum, and offers an EBITDA margin of 10 to 15%. We have recently commenced a small-scale trial along selected routes in the northwest of England to extend our recycling service to non-news and magazine customers. This trial will be crucial as we seek to build our understanding of potential dynamics and secure customers beyond our existing independent retailers. Part of our trial process will be to assess market appetite for our services alongside a more appropriate and efficient method to acquire new customers. Our aim is to drive a deeper understanding of the broader economics of the sector, notably the cost of acquisition and the cost to serve. The results of the initial trial will determine how we can scale the service across our broader footprint. Now, as we know, regulation is increasing in this area, with simpler recycling and the returns deposit scheme both set to go live in the next 2 years. We believe both will be helpful in creating further demand for our services. Finally, we have appointed a managing director to our recycling operation. We have deliberately chosen a highly commercial director from the waste management sector to help us build the capability required to exploit the opportunities in this growth market both now and in the future. We expect them to join by the start of the new financial year. Moving on to look at our new categories vertical. This area seeks to capitalise on Smiths News warehousing and early morning final mile services and diversify the suite of products we deliver. We've continued to make progress in the period, delivering books and home entertainment to multiple national supermarket chains. Our ongoing investment in our warehouse management system has enabled us to consolidate activities into a single hub to drive further efficiencies and, importantly, create future capacity for broader expansion. We also commenced our collaboration with Hallmark in the period, trialling the selection and delivery of a bespoke range of Hallmark greeting cards to our independent retailers. This is a good example of our strategy at work. An independent retailer can now get their news and magazines and collectibles from us, also their greetings cards, and we can collect their recycling. This enables both parties to access the benefits of a deeper relationship, utilising our existing warehouse and final mile capabilities. Turning to the final mile vertical, our supply chain is the critical element in building out this area, and we are actively exploring a number of operating models to further understand where we can maximise value across our footprint. Smiths News has a unique, in-depth knowledge of the dynamics of the early morning final mile delivery market, and we believe we can use this expertise to expand our customer offering in this area. As an example, the engineering parts sector is currently serviced by multiple stock delivery options, including roadside vehicles, lockers, or forward stock locations. We think there is a place for Smiths News within this ecosystem, so we are working to understand how best to maximise our market and revenue opportunities in this area and have commenced a small-scale trial to better understand that market. We are committed to further expanding beyond our traditional operating model, and as highlighted across this presentation, our teams are busy trialling and testing in sectors and areas where we believe we can sensibly evolve our market reach. As highlighted in November, our 3-year investment programme has now commenced, increasing investment to £6 million per annum over the next 3 years to future-proof the business. Part of this investment will help us optimise warehouse operations and enhance our capabilities and efficiencies to support both existing operations and our growth verticals. We've already implemented a new warehouse management system at a key regional hub, on budget, on time, and with no disruption or service interruption to our existing customers. And we are rolling this out across our other 2 major hubs during the second half of the year. This additional investment ensures we have the systems and structures in place to maintain our high level of service delivery and remain a trusted partner for our customers across all 4 verticals. So, in summary, our news and magazine vertical continues to underpin the business's good performance, and our growth verticals are all progressing well. I've outlined a number of ongoing trials across the business, which will provide us with more clarity as we seek to further leverage our early morning supply chain expertise. The cost out initiatives continue to deliver scale savings, and our internal investment programme will support both our news and magazine activities alongside our recycle, new category and final mile. As we did last year, we should assess we should assess our cash generation alongside our investment needs at the end of the year before deciding on further capital allocation. Pleasingly, Smiths News remains on track to deliver full year results in line with market expectations, and I look forward to updating you all again in November. That concludes our presentation for today.
Thank you, John. Thank you, Paul. Really nice presentation, and nice to see some growth coming through at the profit line, which you must be really pleased about. I have a few questions for you to run through, if I may, just to help people understand the story better. So I'll kick off with a question about the core business, core news and magazine business. Do you expect to see any change, either positive or negative, in the rate of volume decline? And to what extent do you expect volume declines to be offset by cover price rises in the future?
Yeah, good question, Andy. I mean, I think the trends are pretty well established in the news and magazine market, as you've seen over the last few years. So we're not forecasting any material changes. We do still see a number of cover price inflationary increases coming through. I think we had 21 in the half year, which is similar to previous years. So for the time being, we're forecasting the trends to be pretty stable.
Okay, thank you. I'm just thinking about those declines and your tactic to reduce costs to address those declines. You try to save an annual £5 million a year, which I think you've been very successful at in the past. But a question often comes up is, how confident are you that this can continue to be achieved year in, year out?
Yeah, I mean, it's a great question, Andy. One that we look at every year, right? So we essentially look at it on a 3-year basis. So every year, about this time, actually, we start to look at the next 3 years on a rolling basis. And the teams have a really detailed plan of how we're going to continue to deliver. Now, we've just said that in the half, we've delivered 3 million of gross savings. That's in line with last year, and we'll continue to see those benefits come through in the second half. And we expect that to continue into next year, where we have good plans that are starting to take shape about where we would see them. We know the high level numbers where they're going to come from in the previous year. And actually, some of our technology investment will enable us to start to look at other areas which we haven't been able to access before in terms of efficiency. So I think, certainly in the next 3 years cycle, we can see ongoing cost efficiencies that the business will continue to deliver.
Okay, thank you. And while we're on the subject of cost savings or new revenue streams, Smiths has been looking to diversify for quite some time now. And what you're doing, at least from my point of view, looks really exciting. But I was curious to know at what point did you decide to target the ambient early morning market?
Yeah, I mean, I think probably we first thought about the early morning sector maybe 18 months ago. And you'll have seen over the last 18 months or so, maybe a little longer, that we've been doing a number of trials to understand how our service would hold up in different market sectors. But I think those trials gave us confidence actually that our service is very resilient when you start to transfer it into other sectors. So it's really been the last 12 to 18 months that we've honed that down and said, okay, it's definitely early mornings, and it's these three specific verticals in addition to newspapers and magazines, which is why we're very focused on recycle, new categories, and B2B final mile.
Great, thank you. And whilst you've been thinking about that, what has most surprised you about this opportunity?
That's a really good question. What surprised us? I think what's pleased me, which is not quite the same question, but what's pleased me is how well the business's services as benchmarked versus the other businesses in different sectors. That's been a really nice surprise, I guess. I've been really pleased with the way the culture of the business has really embraced the idea of diversifying and growing into new revenue streams. And so they're probably the two biggest things that have really pleased me: the quality of the service that we're offering and the way the culture has really embraced growth.
Great, thank you. With the recycling in mind, I see that you've appointed a new managing director to drive that business. Can you just briefly outline what experience and skill sets this new director brings to the business and how you can leverage off that in the future?
Yeah, of course. I mean, I think what we've demonstrated for the last couple of years is that there's certainly a market opportunity for recycling. And I think, the fact we've got over 5,000 customers relatively quickly shows that. But we were very mindful of the fact that we're not experts in terms of the recycling space, and that actually to take that venture to the right level, we really wanted to inject those proven skills. So we brought in a highly commercial director from the waste management space, works for one of the largest players in that space, and we're really excited about the sort of commercial lens that individual is going to bring. They're going to work on the executive team and will report directly into myself. So yeah, I think it's an exciting appointment for us and one we're really pleased about.
Thank you. And with this expansion in mind, you're investing a couple of £1 million a year for the next 3 years to future-proof the business. I was wondering if you could outline what this investment is and how that protects the business.
Yeah, definitely, Andy. I think it's an important step for the business to take, investing in the future. And we're investing essentially to secure our core news and magazines business, as well as enabling growth. And primarily it's around three areas. One is continuing our investment in the facilities of the business, but largely it's about implementing a new warehouse management system, which John mentioned in his presentation. We've gone live in one main hub where we've centralised some of our new categories delivery, and that helps us in that space, in the pick pack of those new categories. And we've rolled out to our other hubs, and that's an important investment in the new warehouse management system. The second one, which we're in play with now, we haven't gone live yet, but we're scoping it out, is a transport management system, which will enable us to give more real lifetime data about our drivers, where they are, and also be able to route them more dynamically in the future with our new propositions when that's required. So those are two areas which are forefront. We're also looking at our data as a business and how we manage that efficiently and effectively to help inform both our core and our growth activities, as well as customer relationship management tools, etc. All of that is within the 2 million a year that we articulated we'd increase our investment for, which starts this year.
Okay, thank you. And you've obviously shown a very strong cash flow delivery in the first half. Can you just briefly discuss how this additional investment you mentioned impacts on the cash flows going forward?
Yeah, I mean, clearly it is a 2 million per annum increase, but you'll have seen from the chart that I presented, the business has generated between 20 and 25 million of free cash each year. We've got a 2 times cover dividend policy. There is spare cash in the business to absorb that and not impact dividend, nor impact the ability of the board to look at how it might use the spare cash that's then generated in the business further for our shareholders or for investment in the business. So yes, clearly it's an additional investment and use of that cash, but there's still surplus cash in the business to align with our capital allocation policy to invest in the core, in our growth activities, and then to look at making sure that 2 times cover is secure for our investors going forward. And then we'll look at any surplus cash and what we will do that in due course.
Okay. And with that surplus cash in mind, the debt has been falling rapidly in recent years, which has been remarkable to follow. It's been fantastic. But with that in mind, do you have a target net debt or a gearing level for the business, and indeed, would you ever consider running the business on net cash balances?
Yeah, I mean, as you will have heard in the first half, average net debt falling to 1 million, it brings us close to that point, although there are peaks and troughs in our working capital cycle. So, we talk about average net debt because that gives people a long-term view of what we've done with our balance sheet. But we do have peaks and troughs across the monthly cycle that we need to manage through our facilities, and that peak to trough can be 20 to 30 million. So it is quite significant, but our average debt continues to fall because we have generated strong cash, right? And we consistently do that as a business. The long-term contracts enable us to get security and visibility of that going forward. So, I expect the business to continue to throw off that cash, and the business has been really clear what it intends to do with that. We've said we would always operate at less than 1 times levered. Clearly at the moment we're well below that, but we've said in our capital allocation policy that we'll look at investment that is needed in our news and magazine business and in our growth activities. We'll look at whether M&A, bolt-on M&A, is available to add scale or skills to those new verticals that we're looking at. And up to a 1 times levered business, we would look to those opportunities to see whether they would add value to us. But absent those, I think what we've been really clear about is, we would look to return surplus cash to shareholders by way of either special dividend, which we did last year, or any other means. But that comes after we've looked at the core and growth activities.
Right, thank you. You perhaps almost answered the next question I was going to put to you, which was on dividends and specials. Given the situation, for investors, what is the likelihood, do you think, that other specials might be declared in the future at some point, similar to what you declared last year?
I think what you get with Smiths News, Andy, is visibility and transparency, right? So I think we've been really clear about the cash we've generated in the half and our expectations for the second half, but also that the board needs to consider the investment requirements for the news and magazine business and growth, and we don't know what the next 6 months might bring in terms of either investment requirements from the business point of view or from potential M&A. There's nothing currently in play, and absent that, I'm sure the board would look at ensuring we don't continue to build cash on the balance sheet, and we look to distribute that in due course.
Brilliant. Thank you. It's very clear. Just as a sort of a topical question, just to finish off, much has been written about what's happening in the US with regards to tariffs and AI. Probably AI may be more important for you than the former. Just briefly, do you see either of these as a threat or indeed an opportunity for the company?
Yeah, well, certainly we're not really impacted directly by the tariff situation. We're pretty much a UK-centric business, so no, we're not impacted by that. Like every business, we're considering the merits of AI and how it could support us going forward. But we're very much at the early stages of that. So in terms of both tariffs and AI, no, we're not looking at those as material impacts on our business in the short term. Brilliant.
Okay. Thank you very much, John. Thank you, Paul, for your time. That was Smiths News. I'm Andy Murphy. We are Edison, and thank you very much for listening and for your time. Goodbye.